Hi, everyone. This is Viral Acharya from NYU Stern. I'm recording this video for the keynote speech at the conference. My apologies, I can't be there since it's at the beginning of the semester in the US, more importantly, the beginning of the school year. But I'm very grateful to Fari for inviting me to give this talk, even though I can't be there in person. So what I thought I'll talk about today was based on a research paper I have done called Whatever It Takes, the Real Effects of Unconventional Monetary Policy, which is joint work with Tim Eisert, Christian Eufinger, and Christian Hirsch. The reason why I chose to speak about this topic is because as we talk, the Italian banking sector, in particular in Europe, is going through quite a bit of difficulty. In my opinion, they have been in a difficult situation right since 2008, at least particularly since 2010. However, what has happened since the end of 2015, beginning of 2016, is that the non-performing loans of Italian banks have really risen to a very substantial number. In fact, some estimates put them close to 10% of Italian GDP, which is just massive. Some of the banks have been declared insolvent, such as Monte Paschi di Siena. Other banks are operating at phenomenal leverages like UniCredit and even some of the other smaller banks. And the interesting question is why? We've been going through a series of banking sector stress, but at the same time stress tests in Europe. The monetary policy has been extremely accommodating. In fact, it has been unconventional now in sort of any way imaginable. And yet it seems that the banking sector in southern periphery, notably in Italy, but even in Spain, Portugal, is actually not doing that great. And I want to provide some perspective on why this is the case, why unconventional monetary policy and the stress tests in Europe aren't doing the job. And I think it's important to understand this because very soon we'll be hitting 2017, and there'll be, like a 10-year anniversary in August 2007 of the outbreak of the global financial crisis. And it won't be too much of a stretch or an exaggeration to say that at least some parts of Europe have had a fairly stagnant period over this, maybe even you could call it a lost decade, the way Japan has. And in some sense, my message from today's keynote is really going to be that, which is that maybe we actually didn't learn the lessons from Japan as far as European banking sector's resolution was concerned, which is that we didn't recapitalize the banks. We gave them tons of liquidity through unconventional monetary policy, but we really didn't fix their balance sheets. And when you try to adopt unconventional monetary policy, the hope is that your banking sector will transmit that liquidity, low rates, etc., to the real sector, to productive aspects of the real sector. But I think there is a very big necessary condition for this transmission to take place, which is that your banks have to be healthy. Your banks have to be in a state where they're going to take decisions for lending to the productive parts of the real sector. They're going to make loans which are positive net present value from an entire bank's balance sheet standpoint, and therefore from a societal standpoint, and not just do bad lending or zombie lending, as was called in the case of Japan, which happens when banks are sitting on so little capital that they basically want to not recognize losses. So you roll over loans to your corporations, which are actually in the most difficulty. So I think we have a zombie lending problem, in my opinion, in Italy, to an extent even in Spain. And I think rather than doing more and more and more of the same stuff, I think the regulators in Europe, European Central Bank in particular, in my opinion, should really take a bold step to figure out if you can get some consensus to recapitalizing the European banks. So let me now get to the details of what we do in order to make these points sort of convincing, demonstrate them with help of data and so on. So what we do is we look at the now famous Mario Draghi speech of July 2012 in London, when he said that the European Central Bank, within its mandate, is ready to do whatever it takes to keep the Eurozone together. Read in between the lines, what this meant was that Spanish, Italian bond yields that time were rising upwards of 400, 500 basis points over the German Bund rates. There was a risk perception in the market that this might mean a lack of Eurozone stability. Countries like Italy and Spain might have to exit. And ECB basically said, listen, we'll buy these bonds. They came out and spelled out the details in September of the year afterwards. But essentially what it meant was we'll do open market operations, outright monetary transactions, OMT, as this famous speech and the operation are called. And that, we'll buy these bonds, we'll keep the government bond yields low. And if your concern is that it's really the rise in government bond yields which are going to cause Europe to break up, we are not going to let that happen. Now, in many ways, ECB succeeded in achieving this. In fact, the OMT program, the outright monetary transactions program, has not been activated. They actually never went and bought any bonds in the market. But the mere guarantee that the ECB stood behind these government bonds and was ready to purchase these bonds in the market if the yields went up seemed a credible signal enough to the market. The Italian and the Spanish bond yields have come down dramatically. And in some sense, the Eurozone stability objectives have been achieved. And yet, in November of 2014, Mario Draghi gave another speech where he justified the need for quantitative easing, direct buying of now even corporate debt in the market. When he basically said, we've achieved all these benefits, we have at least stabilized the banks immediately because banks were holding huge quantities of Italian and Spanish debt, especially the Italian and Spanish banks respectively. And as the bond yields came down, they had a huge windfall gain on their balance sheet. But he said that this has not transmitted into the real sector gains. We don't see growth in productivity, growth in employment, growth in sales, etc. And so the European recovery had looked very anemic. In fact, it still looks very anemic in my view since that big announcement of 2012. So in some sense, if I was to be a tough assessor of ECB's policies, I would say, like everything else that's happening in Europe, they've avoided a catastrophe, which is they've avoided the Europe and the European banking sector from falling off the cliff. And yet, the real sector gains are really very muted. And now, as I was mentioning earlier, there are parts of the banking sector which look actually extremely risky and have realized a lot of losses over the last, which have of course been accumulating over the last 3 or 4 years. So why is this? Why this lack of congruence? So if you look at any event study that's done around ECB's OMT announcement, they rightly document that the bank debt became stable, so credit default swap spreads of banks came down. There were substantial equity gains, equity of banks, especially in the GIPS countries, so in Greece, Ireland, Italy, Portugal, and Spain, registered of the order of 10% percentage market gains in equity value. But the key point is that the GIPS banks, the banks in the periphery countries, were so leveraged to start with that even a 10% equity gain starting from the base value is simply not good enough to have recapitalized the banking sector well. Now, ECB's primary objective was to stabilize the Eurozone. They did that. But what the OMT did achieve was some amount of a backdoor recapitalization. But the point I want to highlight, and this has not been appreciated as much, is that GIPS banks were operating at simple leverage ratios of the order of 25-30, which is 2.5 times that of the US banks right now. And if you look at their market equity based leverage ratios, the worst GIPS banks are actually operating at market leverage ratios of the order of 50 to 60, which is again 6 times that of the US banks right now. Even if you took some of the core country banks in Europe, these leverages are extremely high. So, if you have such high leverage and I double your equity, it's not going to produce a massive improvement in the reduction in the leverage of the balance sheet of the bank. Now, why is this point important? This point is important because what does an undercapitalized financial institution attempt to do, especially when it has some implicit or explicit backstop from the government? It has a central bank around that saying, I stand ready to give whatever liquidity you want, even against collateral that the market is not willing to lend against you. What does such an undercapitalized institution do? They gamble for resurrection. They want to invest in assets which don't produce any increase in the capital requirement on the balance sheet of the bank, because shareholders don't want to invest in additional equity. It's primarily going to stabilize the creditors of the bank when the slivers of equity are so low. And they're going to go, therefore, into assets that don't add to capital requirements. And second, they want to go into assets which are very high risk return profile, because this is a gamble for resurrection. It's like a trader who's on the verge of failure, who wants to double up his trades, hoping for an up and out outcome that will, that in this case will salvage the equity holders as quickly as possible. Now, think about the dynamics here. Now, prior to the OMT announcement, the sovereign debt was a very risky asset, but it was at zero capital requirements. So European banks actually loaded up on this asset class. Now, once ECB came and stabilized this asset class, what was the biggest risk to the equity of the European banks? The biggest risk was that the corporate debt that they had on their balance sheets, given the anemic growth in the southern periphery countries, would actually default, and now you could make losses on these. If you had to record these losses, your book equity would get wiped out. It would lead to shareholders essentially losing the bank to the regulators in one way or the other, or to other banks. So now they got into a mode where they said, we don't have a zero capital requirement risky asset class that we can bid on, because OMT has stabilized this risky sovereign debt. So let's avoid the losses. Now, how do you avoid losses if you are a bank? The simplest way of avoiding a loss is to simply extend the loan that you have to a borrower who's about to default on you. Now, think about this a little bit. Most likely when a borrower is about to default on you, they will probably be loss making. Their interest coverage ratios will be extremely low, possibly even negative, because they've been making losses. So in order to postpone the loss recognition for at least a decent amount of time, you would have to effectively extend the maturity of the loan and reduce the interest rate on the loan quite substantially. So how do you do it? You can simply roll over the existing loan that you have. So it's called evergreening in emerging markets. It was called zombie bank lending in Japan. Essentially, you extend a loan that's going to default by rolling over that loan to a new maturity date and resetting the interest rate to a phenomenally low level. You basically become super aggressive in extending credit to precisely the worst borrowers on your balance sheet, because they are the ones who are going to cause a dent in your equity capital and lead to regulatory actions, takeover by other banks, and so on. So what we do in the paper is we use the loan syndicated data from Thomson Reuters. We match it with Amadeus database on corporations in Europe, and we essentially try and study the terms of bank lending and the change in the quantity of bank lending in Europe following OMT and prior to OMT. And our key point is going to be to identify how OMT affects better capitalized and worse capitalized banks in Europe differentially when I talk about this. Okay, so let me go through the results fairly quickly now, since I only have about 6-7 minutes before I wrap up. So the first result is that at a macro level, it looks like OMT actually boosted bank lending. especially of the worst capitalized banks which had been engaging in a credit crunch prior to the OMT because they were loading up on government bonds and not lending to the corporations. Now, if you don't investigate the quality of the credit lending that is taking place, the quality of borrowers to whom the lending is taking place, this would seem like a win-win. Okay, that OMT came, stabilized government bonds, saved the euro from collapsing, and lo and behold, our banks are transmitting all this to the real sector. But you really need to be sure when your banking sector is not well capitalized that they are actually making the right lending decisions from a societal or an overall banking and economy standpoint. So what we did next was to see what are the kind of borrowers that are actually getting the credit and which are the kind of banks that are expanding credit. And what you see is that the banks that are expanding credit to in the aggregate are primarily the worst capitalized banks, and they are extending credit to the lowest interest coverage ratio firms in their balance sheet. Now, this is somewhat surprising because in some sense you would expect if these low interest coverage ratio firms are really truly economically solvent, it shouldn't necessarily be the case that it's the worst banks that want to lend to them. Even the healthy banks should actually want to lend to some of these firms. But what you find is exactly the opposite. The healthy banks, the better capitalized banks, are withdrawing credit from the worst firms and lending credit to the healthier firms following OMT, which basically generates liquidity for them in the capital markets through bond issuances, etc. Whereas the worst capitalized banks, which also get access to the liquidity because of the windfall gains that ECB has conferred upon them, they are using the liquidity to do exactly the opposite. They are extending more credit to the worst borrowers they have in terms of interest coverage ratios, and they are withdrawing credit from their relatively better borrowers. So what we do next is dig a little bit further into this. So following the work of Caballero, Hoshi and Kashyap in case of the Japanese banking crisis, we classify what are candidate zombie loans. Okay, so a zombie loan is one which has been made at an interest rate which is lower than the interest rate to the safest, the AAA rated borrowers in France and Germany in our sample. Okay, so we are going to look at the lowest interest coverage ratio firms in the GIPS countries and also in other countries, look at their terms of borrowing before and following OMT, and around that time when a loan is being made to a corporation, what interest rate is being charged on it relative to the safest corporations of France and Germany. And then using this, you can classify firms that are receiving zombie credit as potential zombie firms. Okay, so first things first, what you find is that prior to the OMT announcement in July 2012, the zombie lending fraction of the banking balance sheets in Europe is of the order of 4 to 5%, and it's actually declining somewhat leading up to the OMT. Perhaps because banks are actually losing access to market liquidity, and that market discipline is forcing them to actually withdraw credit from these worst firms. Post OMT, however, the aggregate number of zombie firms which are receiving zombie credit grows up to 10% within 1 year after the OMT announcement. And worst, if you look at the difference between the better capitalized and worst capitalized banks, prior to OMT, there is not a substantial difference in their zombie fraction. But post OMT, the worst capitalized banks actually have a 20% number for their zombie lending as a proportion of their overall lending, compared to better capitalized firms, which, as I explained earlier, are actually continuing to reduce their zombie lending fraction. So this is quite a stunning result. Let me give you an example. So United Colors of Benetton is probably a firm that most of us know about. You know, they're always selling nice t-shirts and other stuff at airports. You go anywhere in the world right now, they are engaging in massive sales all over. This is true in India, this is true in Italy, it's true in the United States. United Colors of Benetton has been losing its market share to Zara and other textile retailers over a good 10 to 12 year period. In 2012, at the time of OMT, it was a loss-making organization. The loan that they had received from an Italian syndicate, including UniCredit, had prior to 2012 had a borrowing rate on the order of 200 basis points over that of French and German firms. Post OMT, their borrowing rate was 40 to 50 basis points lower than that of the highest rated German and French firms. Now, this is a firm that has a negative interest coverage ratio. Its loan is being rolled over effectively at a cost of borrowing that's so much cheaper than even the highest rated firms. Fraternelli, which is a publishing company in Italy, is another such prime example. Now, the point is, why is this important? This is important because we show two further results that make it, let me say three further results that make it clear that this zombie lending is really problematic for the real sector in Europe. First, once we classify firms as zombie firms based on their lending rates and characteristics, what we find is that even within the lowest interest coverage ratio firms, the zombie firms are the weakest. They have the highest leverage, they have the lowest interest coverage ratio, lowest profitability, and lowest return on assets. So they are actually the worst of the lot. Second, you could make the case that perhaps banks knew that these firms are going to turn around, okay, that they just had financial problems that have made them look really bad. These are actually the best firms out there within the low interest coverage ratio firms. But what you find is that post the extension of credit following OMT to them, so post zombie lending, their performance never really recovers. They don't invest, they don't increase employment, they don't increase sales. They are primarily hogging the resources that have been given by banks to them in the form of cash levels because they have such severe debt problems that they can't afford to invest. It's a classic Myers 1977 underinvestment problem of these firms that the banks are just feeding, hoping for some sort of a turnaround and postponement of the recognition of losses. Now, and third, someone could say, oh, but at least maybe the counterfactual was that their employment numbers would have been even worse, their sales numbers would have been even worse, and we kind of put a floor on the real sector outcomes for Italy, Spain, etc. by doing this. But the important point to remember is that when banks are extending credit to the worst firms in the economy at the expense of better firms in the economy, this is exactly what the undercapitalized banks are doing. They are extending credit to borrowers who are going to default and not extending credit to the healthier firms on their balance sheet. You are actually crowding out the good when you do this. You are throwing more money after the bad. So what we do is we essentially go sector by sector and calculate what is the zombie fraction of firms that are receiving this super aggressive credit. And what we do is a cross-sectional regression to identify how much are the healthy firms in a sector adversely affected as a function of the zombie fraction of firms in your economy. And based on these sort of partial equilibrium counterfactual exercises, what we find is that Europe over the 2012 to 2015 period might have lost in certain sectors like Italian construction, Spanish construction, Italian manufacturing, as much as 3 years of investment and 3 years of employment for the healthier parts of the Italian economy. Essentially, creative destruction didn't take place in the real sector, in the industries that received the zombie lending. So let me summarize what I really want to convey. The main message I want to convey is that unconventional monetary policy is ultimately targeted at stimulating the real sector of the economy. For that to take place, you need a transmission mechanism that your banks have to take the liquidity and the low rates of borrowing and use that to make loans to the productive parts of the economy. A necessary condition for this is that your banks be healthy. They have enough skin in the game of the balance sheet so that they make positive net present value loans for the bank as a whole. But when you have parts of your banking sector that are severely undercapitalized, as in the GIPS countries, and you throw liquidity at them, you give them cheap money, what they're going to do is to do zombie lending exactly the way that Japanese banks did, following lack of recapitalization, but extension of generous liquidity by the Japanese central bank in the 90s. We didn't learn this lesson. I think we should learn this lesson in context of Europe. We might actually then reduce the impact that bad lending by banks in periphery countries is actually having on the real sector of the economy. The last thing I would add here is that as you follow Financial Times or any other coverage, you will see that Italian bank losses are accumulating. What we find is that the zombie banks that did zombie lending are the ones that are accumulating the largest NPLs on the Italian banking sector in particular. So recapitalize banks first, then adopt unconventional monetary policy. This is what the US did through TARP and stress tests of 2009. They were roughly coincident, or even recapitalization preceded, TARP preceded the QE. Europe has not followed the correct sequence, and it needs to get political agreement to recapitalize its banks. Let me stop here. The paper is available on my website. If you have further questions, please send me an email. I would love to hear your feedback. Once again, thank you to Fari for making this possible in spite of my not being able to be there. Thank you very much. Bye.